Alright guys, welcome back to episode 2 of the ICT Forex Mentorship 2024. Before we begin, I'd like to give a huge thank you to everybody who's reached out and commented, sent me a message. If this content helps you, then that's extremely encouraging to me. Now, I apologize for getting it out late last week. The issue that I have is I can talk about one chart for hours. And I know some of you really want me to make it detailed, but I do have to think about the wider audience, that not everybody is going to be at a high enough level to understand absolutely everything that I can talk about in these charts, right? It takes me quite a while to put the slides together. Generally, I do my analysis and create the slides over the weekend. I will usually record either Sunday or Monday morning, get the edits out of the way, and then upload the video to YouTube Monday evening. Now, sometimes I'm going to be early, sometimes I'm going to be a little bit late. There's just too many factors to control sometimes. Life gets in the way, right? And I do have various other businesses that I run alongside my education platform and my trading, as well as having a family life and stuff, right? The best thing to do is just subscribe to the channel and click the notification bell, and you'll be notified when a new video drops. Now, I've had another ridiculous amount of questions and messages, and again, like I said, the feedback's been insane. I know that when you see somebody on social media, especially the stigma attached to somebody selling a course, I guess the default for everybody is to just label people as a scammer, and this brings me on to why I have decided to do the mentorship on YouTube. I think from the last lesson, which really only scratches the surface, it really showcases the amount of time that I've put into learning these concepts. There's only so much I can type in a post, and it got to the point where there was just so much watered down garbage by marketers trying to sell courses. And I thought, okay, cool, well, I'll show you what I'm really about. My private students obviously know this. I've been doing this now, teaching for years. And that brings me on to a couple of questions. Like, number one, I've just answered, why do the mentorship for free? I know I could slap a price tag on this, and with the following that I have, I could make a lot of money out of it. But there comes a point where money isn't everything, right? It's not enough. By the will of God, I've made a lot over the years. So this is something that brings fulfillment to me, right? The partnership with Funded Peaks has given me a reason to do this. I guess I was looking for an excuse, and the reason that I stopped in the first place was because of personal issues that was going on in my life, right? Every one of us are going to experience certain things, and I couldn't justify the time that I was putting into it at the time, which unfortunately is why I had to close the mentorship in the first place. I enjoy teaching. This has really become a passion of mine, and when I hear the countless stories of people that I've helped along the journey, that really does motivate me. The other question people keep asking about how to join ICT's private mentorship, and how do you become a charter student and one of his private students in his community? You can't, right? ICT closed his private community many years ago. And the question I'm asked a lot, is there any difference between being a public student and one of his private students? The short answer is no, not anymore. Pretty much everything that he taught us in his private mentorship, he is taught for free on his YouTube channel. The difference was we had years and years of being able to sit with him on a weekly, daily basis to break down the charts. The chartered material that was released for free on YouTube was released because we had a vote within the private community. A lot of people don't know this, but the charters came together and we agreed that ICT could release the content that we paid for free, but the promise was he was going to keep teaching us and sit with us through the charts, and that's basically what he does. We have a private Telegram group where not every day, a few times a week, he sits with us and talks about what the market's doing, points our attention to where we should be looking, gives us certain teaching points, and is really there as a guide. Truth be told, if you're at a reasonable level, you do not need ICT's guidance anymore. It's cool to have it, don't get me wrong, but I've been independent from ICT for many, many years, and it's something that I want to stress with my own students or people that want to learn from me, is that you want to get to a level where you are just confident in your own ability, and that's going to come by way of time and experience. Now, I've only really scratched the surface with the first episode. I mean, it goes a whole lot deeper. For now, I'm going to stay for the next week or two on the higher time frame charts before we get more into intraday price action. I've had a lot of questions about intraday 5-minute, 1-minute charts, and I'm going to tell you something. Your whole focus, especially when you're learning in the beginning, should be on your higher time frame. The weekly, the daily, the 4-hour, those are the charts that you should be focusing on. The reason you're asking me, does this work on 5-minute and 1-minute charts, is because you're in a rush to get into a trade, right? You're looking for entry techniques. And I promise you, in a list from your highest being most important and your lowest being your least important, your entry techniques are quite low on that list. There are tons of things that come before entries. And I know it sounds unlikely, especially in the beginning for new traders, because you're so in a rush to get into the markets. You want to get into a trade. And that's the way these markets have been designed. They've been designed to entice you into taking trades. You should approach your trading with only trying to select the highest, best quality trades. And in the beginning especially, the slower you go, the better it is. The higher the time frame, the slower the market moves. And that gives you time to think. And as you're going to see throughout the course of this mentorship, that price is fractal, right? Dealing ranges are fractal. The problem that you're going to have, and it's something that a lot of my students have encountered, is you're always trying to look for the perfect dealing range, the perfect market maker model. And you're going to find that they are very few and far between. And the reason for that is because we are working with time-based charts, right? There is an element of time distortion within these charts. And because price is fractal, you're going to see something on one time frame and not see it on another, right? And because you haven't trained your eyes enough yet, you're going to at first struggle to see the things that I'm going to show you. But with enough practice and enough experience and enough training your eyes, which is the whole point of me doing this, you'll be able to see the key parts of dealing range theory. ICT often uses the analogy of like each chart is telling you a story. And the characters are familiar even though the story may be slightly different. There's certain things that will stand out to you. And with dealing range theory, this is one of the things that I am trying to train your eyes on to see where things are going to form within the dealing range and how that is fractal. You're not always going to be able to see it clearly, right? And if you can't see things clearly, what should you do? You should sit on your hands and wait. One of the problems is you trying to trade everything that you are seeing because you are failing to control your impulses. And being impulsive is the destroyer of careers. And it's something that I want to highlight very early on in this mentorship because the secret sauce is actually this. It doesn't matter about dealing range theory or ICT concepts or how good you are at technical science, right? The number one thing that makes you successful is not your ability to read price. It helps, definitely. But it's your ability to control yourself. Now, over the years, I have studied and read so much on the psychology of traders and having my own students and having my degree and my background in mental health therapy. This is something that's extremely important to me. I'm very fascinated by the psychology of traders. I'll be releasing a book at some point, hopefully next year, I'm currently working on, where I'm going to delve into the mindset and the psychology of traders using my own experiences and other traders I've spoken to over the years and really nail down on how do you employ the right mindset when it comes to trading. And it really revolves around the idea of being present. When you are present with yourself, you are able to analyze and self-evaluate your emotions. If you are unaware of you being impulsive, you are always going to be impulsive, right? You have to be aware of yourself. You have to be aware of how you are feeling. All of this derives from staying present with yourself. Now, there's a lot of research that I've read on this in different papers, and the evidence suggests that self-awareness is so crucial in being able to control emotions. And the majority of trading is going to be you controlling your emotions, controlling your impulsiveness, your greed, FOMO, all of these negative things that we carry into our trading, because if we are not present, we are unconscious when we are trading. And if you're unconscious, you will give in to these emotions, which is why being present is extremely important. And this is exactly why I tell my students to write down how they are feeling prior to their trading. Write that down in your journal, like physically write it down. And why? What does this do? It makes you present because you have to suddenly think about how do I feel? There were times where I was extremely fearful of getting into a trade. And when I had to sit down and dissect that and question it, like, why am I fearful of entering a position? I had realized because I had built up scar tissue from doing stupid things in the past. I realized that if I started to create a checklist and rule-based trading, and I held myself accountable to those rules, I was less likely to be impulsive. Anyway, I think I've waffled a little too much today. Let's get into the teaching part of this week's lecture. Here in front of us, we have the euro dollar on the weekly time frame. Now, we covered the dollar index last week, and again, I got a little bit carried away, so I didn't get to the euro portion. So what I'm going to do is this week I'll focus on the higher time frame for the euro dollar. Next week I'll focus on the higher time frame for the British pound. So we'd have covered the euro, the pound, and the dollar from a higher time frame perspective, right? And then we can track the market going forward, and we can get down into intraday price action. For now, I want to show you how dealing range theory works on every time frame, from the higher time frame down to the lower time frame. And I showcased that really on the dollar index last week. So this is just going to be, again, another amplification to it. So the first thing I want to bring your attention to on this chart is this area over here. We have ran the buy side liquidity above this swing high, and we have ran the sell side liquidity below this swing low. This is the lowest low, and this is the highest high. I call this the IDR, or the initial dealing range. Now, this can also be the initial consolidation. Why I call it the initial dealing range is because of the way it forms. Now, if you look at consolidations, and again, if you've been through my courses, you will know that a consolidation in itself is a dealing range, right? If you look down here, inside of the IDR, we have this high that's been swept here. We have these relative equal lows that have been swept here. And this creates a consolidation inside of the initial dealing range. You can see how price really moves away from that area, but we'll get to that in a second. Now that we have the initial dealing range from this high down to this low, we can project deviations in price higher. Now, initially when price is running higher, I'm looking at how it's reacting around these deviations, right? You can see how at the 0.5 deviation here, look at the bodies failing to close above it, and how we have this consolidation. And then we really run up into 1 standard deviations of this range. Now, this level comes in at 1.23522. So we want to calibrate this level and round it down to 1.23500. If I hover my cursor over this candle, you can see that the high comes in at 1.23495. So we're going to round this up to the nearest level, which is going to be 1.23500. Now, the 5 levels and the 00 big figure levels is where the institutions are going to be looking, especially on a higher time frame. Again, this is ICT theory, it's all been explained before. But when I am grading levels or when I'm calibrating levels, I'm always looking at big figure institutional 00 levels or 500 levels. And I want to see how price is reacting at those levels. Do they want to run through it and close? Are they rejecting those levels? And this is going to give me an indication of strength. And that feedback I'm going to interpret and make a decision on whether I want to change my opinion, change my bias, or does this confirm my opinion or confirm my bias? So now we can grade this dealing range low to this dealing range high with our DRT levels. You can predict the high and low of a buy or sell program before they form. It's all mathematically derived from the pricing structure. Notice what we have here at the 25% DRT level. We have this buy side imbalance. Notice the consequent encroachment of that buy side imbalance. It overlaps nicely with that 25% DRT level. Also note this volume imbalance that sits in between these two down close candles, and it forms at equilibrium of the IDR, or the initial dealing range level, from this high down to this low. Now, what is this gap? Again, my students will know that at the 25% DRT level is where we find our breakaway gap. We're breaking away from this consolidation down here. At the 50% DRT level, what do we have here? This is a buy side imbalance, but more specifically, we call this a measuring gap. You can see how we're finding support at the premium end of that measuring gap. And then price really makes a run higher, creating the high up here before the market going into a sell program. If we look down here, we have that original consolidation inside of the initial dealing range. Notice how price runs and closes above the 25% DRT level, right? So we have our consolidation and we expand through it on a closing basis. We then have this retracement and then we expand with a close through the measuring gap at that 50% DRT level. Price then goes into another area of consolidation before expanding and closing through the 75% DRT level. I call this the terminus gap. Why the terminus gap? Because we're in the upper quadrant of the dealing range. Price is going to be in a hurry to run above this swing high and liquidity to the left, or an imbalance to the left. And this is going to happen in the upper quadrant of the dealing range. So we have terminus up here, and we have our original consolidation down here. What is this? This is a market maker sell model. We have the initial consolidation inside of the initial dealing range. We have our first stage of accumulation, our second stage of accumulation, and then the run to terminus at a calibrated big figure level. Now, ICT talks about the measuring gap. Now, he hasn't explained this, so again, this is just a theory, and I've been very careful about delving into things that I have researched myself, right? There are a lot of things I've discovered beyond what ICT has taught. And I'm very reluctant to, number one, release that to the public because somebody will go out there and just make a course on it. And number two, I'm still testing a lot of these theories, right? And I've been down a number of rabbit holes. I do apologize, I am digressing slightly, but I think I need to get this point out that what ICT taught us is enough. My question is this: if you haven't fully understood what ICT has already given you, why are you going down rabbit holes and looking for other things and trying to find enigma? I've been there and I've wasted a lot of time. You're going to make your own discoveries in price. It's just inevitably happens after years and years and years of looking at charts every single day. You're going to notice things. One of the things that I notice, especially when everything is aligned in price, my grades and my structures, everything aligns. When I'm looking at the measuring gap and I take the breakaway gap low, which I know is going to form around that 25% DRT, and I project a deviation from the low of that breakaway gap to the low of the measuring gap. And if we project one deviation higher and extend this level to the right, what do we have here? This is our terminus gap. If we project one deviation higher, we get 1.23390. This alone is in close proximity to the terminus level that we had already graded down here with the IDR swing. But again, if you've been a student of mine, you know that I grade two things, right? I grade the wick to the tail, and I grade the body to the body. And I also look for projections here. Now, between 1 and 1.5 is when I'm generally looking for a retracement or a reversal after the initial consolidation or the IDR range has been printed. The level we get at 1.5 is 1.23380. Now, look how close that is in proximity. So again, this sits around the area where I'm anticipating a retracement or a reversal. And ultimately, you can see how we reach the terminus of this buy program, and we had a reversal up here. I'll get into a bit more details on the market maker model again at some point. But like I said, I've really taught all of this in the initial course that I have on the website. Now, one of the things that we've been taught about market maker models is that the left side of the curve should align with the right side of the curve. The way the algorithm books is based on previous dealing ranges. Again, something that I've outlined just in the last video alone. Now, I'm going to scrub this chart to the right a little bit, and these three levels where we have the breakaway gap, the measuring gap, and the terminus gap, I'm going to highlight in red and remove some of this stuff just to make sure that you follow what I'm doing, right? So like this, right? So we've scrubbed to the left, and those key fair value gaps are highlighted here in red. Now, you can see how we have reacted to these levels on the right side of the curve over here. So this is the buy program, or the buy side delivery of the market maker sell model. And this will be the sell side delivery, or the sell program of the market maker sell model, running the initial consolidation down here. But for now, I want to draw your attention to these gaps. On the left side of the market maker model, they reside around the DRT levels. The terminus gap here at 75% DRT level, if we extend that out, you can see how we are having a hard time getting above that. The body's here telling the story, and we're rejecting from equilibrium and the discount end of this sell side imbalance. If we look here at the measuring gap, now I've refined this measuring gap. We do have an overlap over here, right? The reason why I've chosen this area here as a high probability area to look for a trade is because we run back through the 50% DRT level, and if you look here, we have a sell side imbalance and we have this buy side imbalance. But we can refine this buy side imbalance because from this candle's low to this candle's high, this is sell side delivery. So if I'm going to take this portion of this buy side imbalance and stretch it across, we've only had buy side delivery here and sell side delivery through this range, making this a balanced price range. But you can see how we've run up, tapped the consequent encroachment here, and tapped the 50% DRT level here, and then gapped lower, closing back below the 25% DRT level. Now, this is significant since it's on the right side of the curve, and it's giving us an indication here that is likely to run the original consolidation. Again, where is this occurring? Around the 25% DRT level, which is our breakaway gap. Look how the bodies are respecting the consequent encroachment of that breakaway gap, this black dotted line here, and the 25% DRT level. Consequently, you see price roll over and run for the sell side liquidity below that original consolidation. Now, this is again just the tip of the iceberg. If I were to explain everything else here, we'd be here for a long time. But I want to zoom out here and show how price really ran that sell side liquidity below that original consolidation, right? If I take this swing high, which was the first swing high after we had this high put in, from this high down to the first swing low, and I project 4 standard deviations lower, we almost nailed a very low over here. Again, if you have been through my stuff, 4 standard deviations is generally how far a program will run for during its distribution phase. And it will generally run from 1 to 1.5 during its manipulation phase. Accumulation, manipulation, and distribution. Notice how we ran through the original consolidation and the 0% DRT level. So this was the low of the actual dealing range. We ran and closed below it, leaving this sell side imbalance. We ran back above, completely closed that sell side imbalance, and then ran 1, 2, 3 drives lower below that original consolidation, really digging into the sell side liquidity below it. Notice where this consolidation is forming. What is this? This is seek and destroy. Right, and it's forming around the 50% DRT level. If we take the range high down to the range low, you can see where equilibrium sits. We're currently struggling to stay above equilibrium. If we take the consolidation, which sat around equilibrium of the previous dealing range, we have a smaller dealing range inside of the larger parent dealing range, and this will often occur at equilibrium. Again, you can see that we're sat inside of the discount region of the upper 2 quadrants. So we have our premium and we have our discount, which is also inside of the premium relative to this high and this low, right? Because we have our equilibrium level here. If you haven't seen last week's episode, I would strongly advise you to watch that so you'll understand what I'm talking about here, right? Let me zoom in here a little bit more so you can see this better. Now, I want to bring your attention to this volume imbalance over here. Notice where it sits firstly, inside the upper quadrant of this dealing range. We also have this up close candle, as well as this high, low, higher, high, where we've got these 2 consecutive down close candles. Again, it's a signature that you're going to find in price, and this sits in the upper quadrant of the dealing range. If we extend these levels out, you can see how we've tapped it here. You can see how we've rejected from the volume imbalance here and then really sold off. So straight away, this is showing me signs of weakness. That is struggling to get above the volume imbalance. I mentioned last week that the volume imbalance is ICT's weakest PD array. So if price is being held at bay, this is giving us an indication of weakness, right? We're also struggling to get into the premium or the upper quadrant of the entire premium range. Below equilibrium, I can see these relative equal lows. Interestingly, this low has failed to go below this low, and this low was the low that caused the immediate rebalance here, right? So it's a very strong signature. I'll be talking about these a lot throughout the course of this mentorship. But below these 2 equal lows, we have sell side liquidity. Now, this sell side liquidity, number 1, sits in a discount relative to this range high and this range low. We also have this low, and this low forming a trend line, right? So retail are going to look at this as support. I look at this as an area of a buildup of liquidity, especially with the equal lows over here, right? Below this trend line and below this sell side liquidity, what else do we have? We have this buy side imbalance. Shit, I've put sell side imbalance here. I do apologize. It should be buy side imbalance. But why have I chosen this portion of price action as the buy side imbalance? Because this candle here, which is an up-close candle that has eaten into this buy-side imbalance, is an up-close candle. And the same goes here. This candle that has eaten into this buy-side imbalance is an up-close candle. So I'm taking this low to this high, and this is going to be the buy-side imbalance that I'm targeting, which sits below the liquidity and sits below equilibrium. We also have these consecutive down-close candles here, right? And again, these sit in the lower quadrant of the dealing range, and we haven't yet traded into the high. So if I were making the market, I'd like to see price run lower to upset that trend line, rebalance this and tap into the order block. But this profile here of this consolidation, this is tricky. It's very, very difficult. And again, this is a sign of where we currently are, right? The economic climate isn't great, okay? There's so much stuff happening all over the world, which is making things very, very uncertain. When it's uncertain, the large speculators and institutions with the deep pockets want to stay on the sidelines. And we could stay in this prolonged consolidation for a while. There will come a point at some time in the future where the markets will start moving nicer and we'll have price action like this. This is really, really easy, nice price action, right? If you compare this, right, to this, which one do you want to be in? Anyway, let's zoom into the daily time frame. Again, we have a dealing range, right? From this high down to this low, we have a smaller dealing range inside of that larger parent dealing range, and equilibrium is this green line over here. You can see how we're rejecting equilibrium over here, failing to close above it, and then what happened? Price really ran lower, creating another dealing range, right? We ran buy-side liquidity here, we ran sell-side liquidity here, making this our DRT high and this our DRT low. So let's zoom into this area. Now, since we have our high and low, we can now grade this range with our DRT levels. Note where we currently are. We're at this equilibrium level. I'm looking at this area here because I'm always looking at what retail are looking at as well. There's going to be this trend line that they're looking at. Where we are currently at equilibrium of a range is difficult, right? Generally, I don't like to trade once we're around equilibrium of a dealing range. I suspect that price may want to push higher and potentially rebalance this sell-side imbalance, right? Because again, the premium end of this sell-side imbalance sits inside of a premium relative to this high and this low. If we run higher, we would upset the trend line. The way prices run higher is lethargic, right? We had an imbalance over here. We had this down close candle as an order block, and we had this sell-side imbalance, which became an inverse fair value gap. Again, look where it's resting, right? I just realized that I've done this upside down. Again, my apologies. So this should be the 25% DRT level, right? We're finding support here. Look at the bodies of the candles here, really respecting the discount low of this sell-side imbalance. We then ran higher through this sell-side imbalance over here. So the consecutive down close candles here with the sell-side imbalance after price ran away is important. If we extend that out, you can see the consequent encroachment of that sell side imbalance. We're failing to close below it. Completely rebalanced this buy side imbalance and then again ran higher. At the minute, does it look like it wants to reverse and break down and go lower? It's too hard to say. I would like to see price run lower, close back below this sell side imbalance and get back below this swing low here. That would give me conviction that the market is likely to reprice lower. But again, I'd like to see it run this high and dig up further into this sell side imbalance before price runs lower. So there's a few things that you have to weigh up, right? Just because I think that the market is going to go lower because of everything that I've outlined from the higher time frame doesn't mean that I'm just going to willy-nilly go in there and start selling, right? There has to be confirmation and there has to be an element of logic behind why price is going to do what price is going to do. Anyway, I think this is going to be it for today's lecture. Next week, I'll go over the British pound. And again, hopefully after that, we'll get into a little bit more intraday price action and working with a few different models. I hope you guys have found this insightful. If you currently aren't on our mailing list, I give a ton of gems and wisdom in terms of psychology and experience through the emails that I send out on a regular basis. We have nearly 50,000 people on that mailing list right now. So I'm incredibly grateful for you guys. So I'll link that in the description below if you are interested. If you haven't already downloaded the ebook, I'll again link that in the description below. And If you are looking for a challenge account, then use my link below. You will get 15% off for a Funded Peaks challenge account. And again, that really just helps support this whole mentorship and keeps it running. Again, thank you for tuning in, and hopefully I will catch you guys again in next week's episode. Take care, guys.